Hey there, traders. Hope you're having a good week. So, an important question that came through from one of the traders was, how do you know which setups are going to run for 20 pips and which ones will probably run for a lot more than 20 pips? I have a general rule. Now, every strategy that exists out there, right, is in some way, shape, or form following the trend, right? What we're doing as traders is we're looking to see if there is structure that we can recognize that gives us some idea that the market is now starting to trend. So remember, if we're looking from the left of the screen towards the right, if the market is creating continual lower highs, so here's a high, here's a lower high than that point, here's a lower high than that point, and then we're looking at continual flows this way where we've got lower highs being created, right? That generally means that the market is maybe trending down. What we need in addition to the lower highs is a continual flow of lower lows as well. So with this this high here, we've got an initial low, all right? And then we go up and we say, okay, the market's reversing down. We've got a lower high than this point here. But notice that this point here and even this point here at this stage is not lower than the previous low. So what we need to do is establish where our actual lows are, and that's where you can start using, let me get rid of this, that's where you can start utilizing these horizontal lines where you drop where the lows are at. And what you're going to find usually is that when price comes down to this area, there's going to be some sort of structure that's established. Okay, a number of ways of looking at it is to say, well, we're not looking to take a trade straight off the breakout of this. Usually, what we want to happen is to recognize the market, or we want to see the after effects of the market having recognized this as a support area. So you'd probably get wicks to the low, hit maybe some sort of a structure, and then where the market does come down, and then utilize this exact area as a resistance area now. And that usually for us means this market is going to continue going south. That's broken. So whatever low is created after this point here is now the new lower low. And it's usually at this point when you can start paying attention to the charts and say, okay, market is now in somewhat of a trend mode, and I'm going to start looking for structures being established at my kill zones. Where would our kill zones be? Remember, for us, it's our EMAs. We pay attention to what price is doing at our EMAs. Now, here's the general rule that I follow. When price is bouncing off the EMA 50, this aqua line, so when it's establishing some sort of a structure, so you've already done your trend analysis, it's establishing a structure at the EMA where it's a double top, double bottom, head and shoulders pattern, maybe even a cup pattern or a bounce off, something along those lines. If it's happening at the EMA 50 and it's moving down, generally speaking, you want to go for about a 20 pip trade after that, inclusive, or add a few pips for your spreads, right? Now, the only time I change this is when that's the first hit to the 50. So if there's a structure that hits it at the 50 and it starts to move down, and my EMA 200, it is bending, but it's not so far off, then that can actually run for a little bit longer than 20 pips. That's, you can get anywhere from 20 to 50 pips that way. But I would still suggest to you guys that treat that as like a tidal wave as opposed to a tsunami or a king tide, where this is about 20 pips, 25 pips, maybe 30 pips maximum. Now, as the market moves away from this first hit and then goes towards a second hit to the 50, that one in itself is a definite only 20 pip trade. That one probably be 20, 25 pips max, right? If then the market comes back for a third hit, usually I will not take that third hit. And the reason is that after the two hits, I'm expecting the market to stall and then to bounce back towards the EMA 200. The only time when I can continue going south is under two situations. One is, and you guys have probably noticed, let me jump onto a higher time frame so you can see. One is when I've recognized that there is some sort of overall structure that exists. So we've got a bit of a channel, and that's going down. Now, remember, when there is a channel, generally speaking, we're looking and expecting for a continual flow, right? So in this case, the market is bouncing off the EMA 200 and the EMA 50. So generally speaking, I'm expecting price to make its way down to the bottom part of this channel. All right, so that's the first part of when you could probably look for more than just two hits to the EMA 50. The second one is when you're relying purely on fundamentals. And you know that the makeup of different news releases that tend to happen is going to show you, for example, if PMI is negative, even PPI is negative, then you could probably expect that, say, retail sales is about to come out, and all of the articles that you're reading is giving you to some degree forecasting information that retail sales would be negative as well. So all of the other indicators that correlate with it will give you that indication. Then only at that point in time will you say, yes, I'm going to kind of continue on, because remember, these key indicators show us that that economy is weakening, and so as a result of that, that currency will be weakening. So the standard structures that we'd follow, like Elliott wave structures, probably won't apply here. You'll just see a continual fall. So it's only at those two times when I'd probably say, look, I'd probably take a third hit to the 50 or a fourth hit to the 50. But at each one of those times, I'll still be wary to see what the other currency pairs are doing. I'm looking for correlation. So if pound USD is doing that, I'm also looking at pound CHF. I'm also looking at Euro USD, AUD USD, and I'm trying to justify that. Is it the US dollar that's continually strengthening, or is it the pound in particular that's weakening? I need to know what the cause of that movement is. And only when I know what the cause of that movement is when I can actually put money down on that trade. Okay? So again, let me just go back to the 15-minute chart. Usually it's the first and second hit to the EMA 50 that I will take. That will justify for me that this is at least a 20 pip trade. Beyond that, what I do is, for the longer term trades, it's at the EMA 200s, right? So the first one again, the EMA 50, and notice here, let me show you an example of this. So let's say, for instance, this is the first hit to the EMA 50, right? And we try and project that this is the second hit to the EMA 50. Notice how price then, it doesn't continue to go down, it goes back up again. So would probably be able to discount this as the second hit to the EMA 50. This is more of, this is the first hit, and then the market kind of just flows, so it consolidates for roughly probably 4 sessions this way. Consolidates for 4 sessions, and then it comes down. So this is now the official second hit, right? Beyond this point here, let's zoom in. Let me show you that. Beyond this point here, this was on a Monday, why would we not automatically say this is a bit of a double top formation at our EMA 50 and go down? It's simply because of these two hits that have already happened, right? So that was the first one. This was a reasonable second one, right? A huge engulfing candle. And let me measure that actually. How many pips is that? So entry on the slight pullback. There we go. That's roughly about 37 pips. So in this case, you still would have been out in probably about 1.5 hours or less, right? In 20 pips. Now, notice how here it's a safe 20 pip trade, 20 pips plus your spreads. If you wanted to push it for longer, yes, you would have gotten more out of that, but you're not certain that this market's going to continue going down, right? The other one is where this is a nice one. We're getting an engulfing candle. 4 candles create a double top formation at the EMA 50, and then it starts to come down. With this trade, there was correlation with the pound pair, so pound JPY, And in that instance, it was really just the pound that was weakening against the US dollar. The Aussie dollar and the euro weren't weakening as much as this was, or nowhere near as much as this was. So that really was the biggest mover out of this. Now, beyond that, when we look at Monday, we've already had two hits to the 50. Generally speaking, it's okay, and this is the reason why I'm wary. You might get instances where this would have flown down for 100 pips as well. But it's those rules that we established that actually prevents us from taking these sorts of entries and then saying, hey, market went up against us. Now, if you would have had a 20 pip stop loss, you would have been stopped out quite easily. So here we say two hits to the 50, take that for a 20-30 pip trade. Usually the first one will run for more than 20 pips. The second one possibly as well. You want to reduce the number of pips you capture there. If there's a third hit and there's no significant fundamentals to back that up, then ignore that. Beyond that, we're expecting the market to head back towards the EMA 50. Why? Okay, we're coming back to, and some of you, I'm finding, those of you that are emailing me right now, are still not familiar with Elliott wave structure. All right, so this way, that sort of stuff. Now, what generally happens is this. Okay, so basically, say for instance, this is the EMA 50, and we have, actually this wouldn't be up here, it'll be probably down here. This is the first hit, that's the second hit, and what we're expecting is that this possibly here, this part, actually let me redo that, that's a horrible diagram. Let me do it here. Okay, so we've got double top formation coming down, first wave, second wave, third wave, fourth wave, fifth wave, right? Okay, so we generally have, say, the EMAs do this, that's the 50, and it comes down, right? And that's what's happening. So what we'd find is this is the first wave that we want to trade, right? So you'd get probably a double top, a head and shoulders formation up there. Market comes down, goes back up, again, double top and head and shoulders formation. Maybe this is the 618 of this previous, it retraces back to 618 of this high. This one probably may be 382, maybe even a 50 retracement back to this high, right? And then the market comes down, goes back up. This is the third hit. This is where, unless there's a fundamental reason, would probably say, look, the market's going to continue going down. I would personally say, no, this is going to come down. It's probably going to do some sort of relationship with this here. So maybe a 50 or a 618 up here. And then it pushes back up, right? And where's this going to? All this time, it's you've got the EMA 200 possibly up here, right? So this is now making its way up towards the EMA 200 to do something similar as this. Okay, so general rule that you guys might like to follow is when you're looking for a trade that's anything greater than 20 pips or so, one, you want it to be at the EMA 200. Okay, you want the full structures, you want to see these higher, lower highs and lower lows established, or higher highs and higher lows being established, right? You also want to be able to see when you're zooming out that the EMAs line up. So we've got the EMA 200 on the 4-hour chart. We've got the EMA 200 on the 1-hour chart. We've got the EMA 200 on the 15-minute chart. And then we've got the EMA 50 sitting here as well. You want them to line up, okay? And that's going to give you more of a confirmation that, yes, we're in somewhat of a trend, okay? So, again, just to simplify this, to summarize it, off the EMA 50s, I look for my 20 pip, 20, 30 pip trades. Usually the first, second hit, I can run for a little bit longer, so it's anywhere from about 20 to 50. But generally speaking, if you're a new trader, get in, get your 20 pips and get out. And with the ones where you'd probably want to capture more than 20 pips, you could probably do a lot more than 50 pips for more experienced traders, would be the trades that you're getting at your EMA 50. Your EMA 200, okay? Now, let me just quickly jump onto a few other charts. I wanted to clarify something for you guys as well. So there was another question in regards to economies to do with fundamentals. If you're looking at two economies, say pound, the UK and the US, and both of them are strengthening. So the question then arises into your mind, well, which one do I trade? Okay, there's two ways of looking at it. One is that if you've got two economies that are equally as strong, then usually you just want to pay attention to the cross pairs. That you're not going to trade the major. But in this case, when you're looking at the US and the UK, there are different reasons why each economy is strong. So you want to pay attention to that with fundamentals. We haven't quite touched upon that in the videos yet. At some point, we'll get to that. But you want to look to see what's strengthening the U.S. economy and what's strengthening the U.K. economy, and then together, that's when you will assess. Okay, at this point in time, I'm expecting a weakness for these reasons, and that's what you will take advantage of. But generally speaking, if two economies are equally as strong, go to the cross pairs, right? And also, you want to pay attention to where and why is the money moving, right? So if there is something that's going to show weakness with the US dollar, for example, if there's extended trade wars, say for instance, if there is, China comes out with more tariffs, so the European Union comes out with more tariffs to do with the US goods, US imports, then generally what you might find is that, okay, if there is a significant reason for the US dollar to weaken, then the money will not necessarily flow towards the pound or to the euro, or the Aussie dollar. In fact, what you might see is that the yen strengthens, right? So that's where the trade opportunities arise for pound JPY with euro JPY, possibly even USD JPY, right? Um, that's where you want to flow. But first things first, please, 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 please. A lot of you that are sending me screenshots, you guys are trading in an environment where the market is seemingly just going sideways, like where the market is here, it's doing this, and you're looking for great opportunities. Look at the EMAs, they're all going sideways here, right? Remember, what we want to trade is this sort of environment where the market is creating, in this case, it's in a downtrend, so lower highs and lower lows are constantly being created. Now, look at, just from a distance, that relationship that the market has with the EMAs. This is our bread and butter pretty much. Just look to see what the market does at our EMAs and if there is reasons to move in that direction. Now, if price is below the EMA 50 and is giving you a double top structure and then a red confirmation candle, there's a higher chance that this is going to continue down. Again, we've had two hits to the 50, right? This probably still counts as one hit, okay? Because again, we didn't establish a lower high. This is the second hit to the 50. Now this one, naturally you'd be a little bit more wary of, right? The other thing that I could mention to you guys is this. For those of you that want to trade more swing trades, when this sort of a behavior starts to happen, and this is usually better with the majors than the cross pairs, is after the two hits, when price goes back up towards the EMA 200, establishes structure and then starts to move again, that's where you want to take a trade, and you might want to be able to kind of just let that sitting. So trail your stops, come back, either come into on par with your entry, or lock in some profits with your stop loss, and then let the market go. So if the market decides to bounce back against you, yes, you've captured your 10 pips or your 15, 20 pips or whatever it may be, but at the same time, if the market continues to do this, then you've captured a hell of a lot more pips, right? So you could probably trail it, because eventually what will happen is price will hit the 200, come down, retest the 50, and then come down again. So that's where you can actually make maybe 2 or 3 times the amount. In terms of money management, please, 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 do not risk a huge percentage of your accounts. Continue down with maybe 5% max if you want to be cocky. Because what's that going to do is it's going to slowly build up your account. It's like an exponential process here, where eventually, as you secure your confidence in terms of the sorts of setups that you're taking, you're building up your account, and eventually what you'll find is that you'll be in a place where you can start taking much higher entries. And again, for the last thing that I want to say in this video, for those of you that have been affected by the ESMA changes, then there are still opportunities in Australia, and also probably with the Dukas Copy Bank in Switzerland. Please be very careful with any other brokerages outside of those regions. Make sure that all of the ones that, if you decide to sign up with them, have to some degree regulation. Look at their dispute resolution process, and also ensure that they are all New York close feeds that they're shooting out to you, and more importantly as well, make sure you differentiate on whether they are a market maker broker or they are a ECN broker. If they are purely ECN, then also look at what their liquidity pools look like. Because a lot of the times you might be great with having an ECN broker, and they might be more of a boutique broker, but the problems then arise where they don't have access to liquidity in order to take your trade when you put in for a trade. That usually is an issue. And for those brokers that are still kind of operating within the ESMA requirements, what you might find is that their revenue levels are going to start to drop. And as a result of that, there is every chance that some of these might want to do something unscrupulous or go belly up. Okay, so be careful of those things. All right, traders, that's it for this video. All the best.